It's not exactly what we were told we were going to get, David, at this time of year.
No, it's not, Jeremy. What we've got is a combination of a huge number of floats coming on, and surprisingly enough, very few are coming on in the black. I think just a handful, and many are coming on in the red. But there was obviously a huge amount of pent-up demand back in late October, early November. And I think also some of the AGMs have been a touch on the disappointing side. And so I think what's happened is that people have taken stock, pulled back, and they're buying a little bit more supply coming on board. And as you said, that the market's off, 6 or 7 or 8 percentage points in the last sort of 6 or 7 weeks.
Yeah. Any of those floats got interest from you? Or?
Well, we had a really good crack at Vader, but unfortunately everyone else did. And as you know, day one it was up 40 percentage points from $1.25 to $1.75. And it's continued to go up a tiny bit past that mark. We're also going into a business called Common Shore, which I think floats about possibly the 23rd of December.
Is that part of the CBA operation?
No, this is actually a specialist travel insurance business.
Oh,
yeah.
okay.
We're capitalised, I think, at about $680 million.
One to watch there, thanks.
Yeah, I think so.
Yeah. And the kind of yields that you're getting on some of the leading stocks now look pretty favourable. I noticed that where we've seen the market really come off is in the higher yield part of the market, banks, infrastructure, REITs. Is it all because the bond markets had to sell off, or is there something else we should be looking at?
Look, I think there is a fear that the US does some of this tapering, this magic word. And what we've already seen in the US in the last 15 months is their long bonds, which obviously aren't controlled by the Federal Reserve, which is the short end, but the long end has definitely sold off. And across the Western world, it sold off by about 120 basis points, 1.2 percentage points. And so I think there's just a little bit of a fear that there's inflationary expectations, long bonds are slightly higher around the world, and yield is good as long as there's earnings growth.
Yes.
But if you don't have the underlying earnings growth, then yield can become problematic in a slightly higher rising interest rate environment.
Yeah. Our next caller is on the line. It's Peter from Melbourne. Good evening, Peter.
Good evening, Jeremy.
How are you?
I'm quite well, thank you.
A question for our panel.
Yes. I bought CSL originally around the mid-40s when Hef said he'd rather buy a stock going up than one that was going down.
Okay.
And I bought a few more since then as well in the 50s. And I'm just wondering, what should I do now? Should I be still trying to buy some more, or what would be a good price to buy some more? I know they go between 69 and 65. I'm not quite sure what they are today, but should I buy more, and what would be a good price to buy some more? That's what I'm wondering.
Excellent. One of the best performing stocks over 2 decades that I've been working in the markets. I remember it floated at, I think, 235.
That'd be right.
Did a consolidation. So
that's right.
That's equivalent to 71 cents or so, and so it's $66, great return. David, you guys liking it?
Oh, it's one of our favourite stocks, Jeremy. Capitalised at $29 billion, return on equity of over 30%, very, very, very sort of strong annuity income stream. And I think Hef made a very good point. If the Australian dollar does bucket at some stage, it will be a significant beneficiary from that. So it's one of those stocks, I think, and you saw the chart up earlier, but you can buy it in pullbacks, and there are always little pullbacks in share markets.
Yeah, look at that, 20 years. It's a fantastic one. So any pullback and opportunity,
phenomenal.
I think everybody seems to like it. Fair question, though. If you've owned it from that time quite early, it could well be a large position for you.
Well, as you say, it's gone up approximately 100 times,
yeah, that's right,
and you've got superb dividends on the way. So on that assumption, it's probably a significant part of your portfolio.
But there's no real reason to not have a decent holding in a company like this if it's got a good balance sheet and like consistent revenues, upside optionality, and some R&D.
Yeah.
Conservatively accounted for.
And a surety.
A surety, yeah. No, excellent. Thanks for your question on that one, Peter. So our next caller is on the line, Scott from Wodonga. Good evening, Scott.
G'day, Jeremy. Thanks for a great show.
Thank you.
My question to you and the panel tonight is, what's the future of Fleetwood?
Very good one. Yeah, thanks for that, Fleetwood, which has had some tough times lately. Obviously, it did run pretty high. I think it might have got to about $14 in better days, and we were just talking before the show about mining services generally. Fleetwood these days is doing it tough. David, Fleetwood?
Well, look, I think on the surface, Scott, it looks reasonably cheap. It's got relatively low debt to equity of about 15%. It's capitalised at about $150 million. It's got reasonably high return on equity, but the problem is that's yesterday's news. For a lot of these companies, there's no doubt about it, they are starting to think about heading into a fairly significant headwind. And I really like reading Montgomery's commentary because they're the sort of the bellwether stock in this entire space. And while Montgomery are forecasting pretty flat revenue growth for this December 2013 half year, what they're basically saying is that the June 2014 half year it could be down quite noticeably. And these are the sorts of bits of information you need because Fleetwood, as I say, are a fraction of the size of Montgomery, as I say, the bellwether stock. And so when you're fighting against a headwind rather than a tailwind, it does make it does make investing difficult. So I think Michael made the point earlier. There's 1,850 stocks listed on the ASX. You only need, a well-diversified portfolio of 10 or a dozen holdings, and you just don't necessarily have to be in stocks that have a massive headwind.
And I think just generally this part of the market, the mining services, which had been on a downward trajectory over the last 18 months almost, there was that discussion about the pockets of value that were appearing, and Fleetwood was one that came up in discussions. Now, it can be an interesting exercise buying ahead of what is perceived to be a near-term bottom, but it can also provide some disappointment, can't it?
Well, what actually happened was this entire sector peaked about April 2012. It then bucketed for about probably 14 months into June 2013, and it really was the last 6 months of that 14 months when it really got smashed. And there were many stocks that fell 50, 60, 70 and 80%. And then Australians, being gamblers, say, hey, X has gone from $1 to 20 cents or $2 to 50 cents. Let's have a bit of a punt. And there was a very good run into the September quarter. But in hindsight, all it was a bear market rally. Yeah. So those things that fell from $1 to 20 or 30 cents, they rallied to 40 or 50 cents. And then what's happened in the last 6 or 7 weeks, many of them have been hit very hard. So it's a combination of Forge going into trading halt for 24 days and coming out with a disastrous announcement. As I mentioned, Montgomery mentioning that the next year is looking tougher than this year in terms of revenue line, and many other companies have talked about at their AGMs that the prospects just aren't that good. And so, as we've said earlier, you only have to you've got 1,850 stocks to choose from. Find 10 with a massive tailwind, not a headwind.
And the reality of this space is the cycles of investment are not that short. They can't just end and create in 18 months. It's years in upside and downside. So
and I think the points made by Michael earlier is a good one, is that's when the majors are battening down the hatches, then there's a massive effect, multiplier effect everywhere. But when the majors, including companies like Vale and the like, are all spending money like drunken sailors, this sector does superbly well.
Our next caller is Bernard from the Gold Coast. Good evening to you, Bernard.
Thanks, Jeremy. My question's for all you guys and your thoughts as well. I have an income portfolio which has the banks, the normals, Woolies, Wesfarmers, Telstra, but I have one property trust in there which is WRT, and I've also got WDC. Now, my question is, with what's transpired with that over the last week and going to be happening in towards the new year with that company splitting, would I be better off topping up my WRTs with the WDCs or vice versa to get the better return for what's happening with that company? Any thoughts with that, please?
Yeah, no, excellent question. I know there's a lot of shareholders of Westfield, and both of them, in fact, and the question is appreciated from Bernard. Let's get to the guts of that. It's a big one, isn't it, David? A big deal.
It is. But look, Bernard, I just go back to basics. Try and buy businesses with high return on equity that are growing, and in Westfield's case, its ROE's been about 9%. So it's not like the good old days where you had the Westfield Holdings ROEs of 30s and 40s and Westfield Trust of 9. Yes. It's now 9. So I think you were talking about some of your other dividend yielders that you own, Bernard, and clearly many of them have, to me, much more exciting fundamentals.
So we're going to have an email now from Sean. Sean's writing, is it a good time to be getting into Telstra now? Well, Telstra's pulled back a bit of late, guys. It pays a substantial dividend, 28 cents. It might be up. Could be around about 8% grossed up. Should we buy it though, David?
We won't be. Look, Jeremy, over the last 10 years approximately, Telstra has earned about 30 cents a share, give or take, and paid out 28 cents or thereabouts more recently. And that's been occurring now for about a decade. And the share price has traded between approximately sort of $3 and $5. Of course, it's gone a bit over $5 and a bit under $3, but basically it's traded in that sort of $2 to $2.40 range now for a very, very long period of time. And I just think we touched on 3 or 4 of the second-line telecommunications companies earlier, and some of those, to us, not only demonstrate extraordinary growth prospects and have done so for many years, their share price performance has been, quite superb by comparison to Telstra.
And Telstra's done well in the last few years, but that chart on the screen now shows that it depends when you bought this stock, how well you did. If you bought it around those lows in 2010, 11,
sure.
very well. But
I'm saying if you're over a 10-year period,
it's not been a great one.
It's just been a sort of, bit of this and a bit of that.
Yeah. Our next caller is Jeanette. Good evening to you, Jeanette.
Okay, now I've been looking at the real estate space and I wanted to know your opinion of OTH and IPP. REA is a little bit expensive now and that's why I've been looking at those two stocks, so I'd like to have your opinion on it.
Yeah, excellent. Thanks very much for your call, Jeanette. And two very interesting stocks. iProperty is one that I certainly follow and have talked about on the show. It's the minier real estate for me, but operating in Asia, where it is the leading portal in Singapore and Malaysia and Hong Kong, and is making good ground there. We believe it'll be reporting positive cash flow. It's been 10 years in making, I might add, and I only started buying it earlier in the year, but it's just on the cusp of going cash flow positive and a bright future ahead for iProperty. So just under $2 at the moment, so it's had certainly a fantastic year. I really waited till I could see that the cash was beginning to really mount up before we went into that, and I still believe this has got a bright future. It's just nice to get that a little bit lower, I would have to say, though, Jeanette. So that's iProperty, which I think is a very exciting stock. Onthehouse, David, one that I know you've had a good watch on.
Yeah, I think we're a little confused by Onthehouse, Jeanette, I'm sorry to say, and that is that some of these small, relatively undeveloped businesses, they've often got binomial results. And by that what I mean is that if they develop successfully, have a little bit of luck, nail some key contracts, which Onthehouse seem to be doing with a few of the banks, then suddenly the business can be transformed quite quickly and you can often get a factor gain. However, if they don't, and they slowly sort of run out of cash and they don't quite sort of really nail it, then the share price can sort of really end up in the doldrums for a long period of time, and then they have to re-engineer themselves. And we're sort of a bit in two minds with which path this one's going to take. So I'd have to say we've moved away from this one, and just we're a bit unsure. So we've let it go on the basis that we sort of think it's a bit speculative.